Hello champions, this video is going to be an ultimate revision of 50 concepts on your exam day. On the day of your exam, just a few hours before your exam, I am taking 1.5 hours of your time. I know what I'm doing, guys. I did the same thing before law also, and you saw for yourself how helpful that was. Exact same manner I am doing this video as well. Even in this video, I have not made my life easier by taking easy simple concepts. No, I've taken those concepts which I think are highly probable from examination point of view, like your buyback distribution tax, then your buyback computation after amendment, then section 54F, section 10AA, a lot of total income adjustments, your national pension scheme concept, a lot of adjustments have been taken up. Okay, 50 adjustments. The first 15 to 20 adjustments, there will be computation also that you will be doing with me. The last few adjustments will be total income adjustments, which I will be discussing with you. So patiently, carefully, with trust that this video is going to help you in those 3 hours during the exam. With that trust, please watch this video from the beginning to the end. You may not have any idea right now how much this is going to be beneficial for you. Towards the end, you will realize. Alright guys, let's begin. Starting off with our discussion on residential status first, I have a question with two subdivisions. Let's see if you are able to give correct answers to this. The first subdivision says income earned from a business in Iran. So therefore clearly the source of this income is going to be outside India, guys. Then this business is controlled from Delhi. Now, controlled from Delhi, this is something which is relevant for whom? It's relevant only for our NOR. And lastly, 65,000 is received in India. So to this extent, it becomes an Indian income because it is received in India and the total amount is 80,000. So the total income is 80,000. It is fully earned outside India. A part of it is received in India and the business is controlled from Delhi. Now tell me, if the assessee happens to be an ROR, what will you say? How much will you tax? You won't even bother, guys. ROR, global income, is taxable. Full 80,000 you will tax. What about our NOR? For our NOR, three incomes are taxed. Number one, incomes which are earned in India. Number two, incomes which are received in India. And number three, business incomes from businesses which are controlled in India, guys. So for RNOR also, the full 80,000 will be taxed because this income is from a business which is controlled in India. Then what about NR? For NR, only two incomes are taxed. Incomes which are earned in India, incomes which are received in India. Now this income is not earned in India. It is earned outside India, but a part of it is received in India. So that part which is received in India, that alone you will tax for the non-resident. Okay, so this was your first subdivision. Now come to the second subdivision. Interest on money borrowed by Mr. Deepender, a non-resident, for the purpose of investment in shares of XYZ Limited, an Indian company. See, whenever it comes to interest royalty FTS, I always tell you draw the diagram. Tell me who is paying interest to whom over here. Interest on money borrowed by Mr. Deepender. So Mr. Deepender, he is the borrower over here. He is the one who is borrowing the money. So he is the one who will pay the interest, guys. So he is the giver of the interest and he's a non-resident. So non-resident is paying to my assessee some interest. Okay, when the non-resident is paying interest, this interest will always accrue outside India. But how many exceptions do you have? When the non-resident is paying interest, only one exception you have, and that is the loan being used for a business or profession in India, guys? Tell me, what is Mr. Deepender using the loan for? Is he using the loan for some business or profession in India? No, guys. He is using the loan to make an investment in shares of an Indian company. He is using the loan to make an investment in India. He is not using the loan for business or profession in India, and therefore this exception will not apply. So this main answer only will apply now. The interest income is accruing outside India. The question does not say where the income is received. Let's say it is received also outside India. So this becomes a foreign income. Understanding, everybody? So whenever it comes to interest royalty FTS, draw a diagram. Here the non-resident is giving the interest. So whenever non-resident gives interest, your first answer will obviously be that the income is accruing outside India. Then when the non-resident is giving interest, there is only one exception. The exception is the loan being used for business or profession in India? No. In this question, the non-resident is using the loan to buy an asset in India, to make an investment in an Indian company. He is not using the loan to do business or profession in India. It is only to make an investment in India, hence the exception will not apply. So my main answer only will apply. You will see that the income is accruing outside India. The question does not say where the income is received, so I'll assume it is received also outside India, guys. So it is accruing outside India, it is also received outside India. That's all, it becomes a foreign income. Okay, so this was my first discussion with you with respect to residential status. Now coming to our next discussion with respect to salaries. Here I want to quickly give you a revision of some concepts. Number one, employer's contribution to RPF. See, first of all, your very first step over here will be to compute salary for the purpose of RPF, and salary will have three components: basic salary plus DA forming part plus employees turnover based commission. Okay, this is going to be a first step. Then after this, you will see what is the actual employer's contribution, how much did the employer actually contribute. Okay, then your third step will be how much exemption will you get? Tell me how much employer's contribution will be exempt for you. 12% of salary. Which salary? The salary which you calculated over here, 12% of salary. So point number 4, how much will be a taxable contribution now? That's all, guys, the difference. How much you received, whatever is the actual contribution you received minus how much ever is exempt, that is going to be, the balance is going to be taxable. Okay, in simple words, whatever is the employer's contribution to RPF up to 12% of salary is exempt. If it is more than 12% of salary, the excess above 12% of salary, the excess is taxable. Okay, so received minus exempt will be taxable. Exempt will be nothing but 12% of salary. But however, the reason why I'm discussing this concept with you is that this part everybody will do correctly, there is no doubt about it. But there is one more point over here, guys, which you should not forget, and the point is that if the employer's contribution to the RPF plus the superannuation fund plus the NPS put together, if it happens to be more than 7,50,000, guys, then in that case you will find the excess. The excess will be taxed as perquisite, and also we will find what is the interest on the excess. Even that interest on the excess will also be taxed as perquisite. Are we understanding, everybody? Yes. So the point which I want to remind you all is this last point. We will see the total employer's contribution to three things: to RPF plus superannuation fund plus NPS put together. Is it more than 7,50,000? If it is more than 7,50,000, I will find the excess. The excess will be taxed as a perquisite under the salaries head. Also, the interest on the excess will be taxed as a perquisite. Okay. Then listen to my next discussion with respect to professional tax. Very, very important, guys. Now, there are 2 to 3 adjustments which are possible over here. Point number 1, what will you do if the professional tax is paid by the employer? See, professional tax is actually the employee's obligation, right, guys? So if the professional tax is paid by the employer, it becomes employee's obligation met by the employer. It becomes a perquisite. So if the professional tax is paid by the employer, it will be taxable. It will be fully taxable under the salaries head. Okay. Then after this, you will see the total professional tax paid. Total professional tax paid, which means whether paid by employee, whether paid by employer, put together you will see this total amount you will get as a deduction under section 16. But this section 16 deduction you will get only if assessee has opted out of 115 BAC. Only then you will get the section 16 deduction. Mind you, if assessee is doing the computation under the default regime under 115 BAC, then only one deduction we get under section 16, and that is standard deduction, that to 75,000. Right, guys? But professional tax deduction we don't get, entertainment allowance deduction we don't get. But however, if assessee is opting out of 115 BAC, professional tax deduction assessee can enjoy under section 16. But guys, the most important point, the whole reason why I wanted to discuss this with you is that many of you may not know that this professional tax is allowed only on payment basis, which means we have to see total how much professional tax has been paid, whether paid by employee, whether paid by employer, total put together how much has been paid, that only you get as a deduction under section 16. Okay, so 2 adjustments, guys. Point number 1, whatever professional tax has been paid by the employer, you will fully tax it. In the salaries computation, you will fully tax it. Then the total professional tax paid, whether paid by employee, whether paid by the employer, in the current year, total professional tax paid, I will get as a deduction under section 16. But this section 16 deduction I will get only if the assessee has opted out of 115 BAC. Okay, this was your third concept. Now coming to the fourth concept with respect to gifts. See, if the employer is giving a gift to the employee, you will see whether the gift happens to be a gift in cash or is it a gift in kind. Okay, if the gift is in cash, I won't even even check anything else, guys, I will straight away say that it is fully taxable. But however, if the gift happens to be in kind, or if it happens to be a gift voucher, then you will see what is the value of the gift. If it is up to 5,000, then it will not be taxable, it will be exempt. If it is more than 5,000, then you have two options: either you can tax it fully, or you can tax just the excess. Both the options will of course result in different answers, but both the answers will be right. So gift in cash, nothing to check, nothing more to check. If the gift is in cash, it will be fully taxable, story over. If the gift happens to be in kind, or if it's a gift voucher, then in that case up to 5,000 the gift will not be taxable. If it is more than 5,000, then whatever is the excess, either you can tax just the excess, or you can tax it fully. Okay, then comes the next point: use and transfer of movable asset. For this, I will straight away take up this adjustment, guys. A 4-seater dining table was provided to Mr. Rajiv at his residence. Was provided to Mr. Rajiv, which means use of dining table, use of this movable asset. This was purchased by the company on 1st May 2022 for 90,000, and then it was sold to Mr. Rajiv on 1st August 24 for 50,000. So sold to Mr. Rajiv, there is transfer also. So in the same adjustment, guys, I have use of movable asset also, I have transfer of movable asset also, I have both. So let's take them up one by one. First of all, use. Now for use, I will do the calculation for how many months from the beginning of the year April to, see, when did the transfer happen? 1st August. So my so therefore the use perquisite is going to be only from April to July, only April, May, June, July, only 4 months, right? So how will you do the computation? If any movable asset is given to the assessee for use, doesn't matter whether the use is for official purposes, whether the use is for personal purposes, whether it is for official and personal purposes, doesn't matter, guys. You will have the exact same tax treatment only, doesn't matter what is the employee doing with the asset. So for these 4 months, you will do the calculation. You will see what was the cost to the employer. The cost to the employer is 90,000, this into 10%, right? But however, this perquisite is only for 4 months, April, May, June, July. So into 4 by 12, it's 10% per annum, guys. Okay, so if the use perquisite is only for a part of the year, of course your computation also will be proportionately for that part of the year only. So this is going to work out to 3,000 rupees. This will be the value of the taxable perquisite for this movable asset. Then comes the next point, which is transfer of movable asset. See, when did the transfer happen? On the 1st of August 2024, the employer sold away the dining table to the employee for 50,000 rupees. So transfer of movable asset, how do you do the computation? You will first start with the actual cost to the employer. When the employer purchased this dining table long back, he purchased it for how much? He had purchased it for 90,000 rupees. Okay, now from this you will subtract normal wear and tear. Now with respect to normal wear and tear, you have to be careful. You will get normal wear and tear only for those years for which the employer has used the asset for his business or profession. So we were talking about transfer of movable asset. So whenever there is a transfer of movable asset by the employer to the employee, you will start with the cost to the employer. From that you will subtract normal wear and tear. But normal wear and tear you will subtract only for those years for which the employer has used the asset for his business or profession. Now over here, if you see, did the employer use the dining table for his business or profession? The employer has actually given it to the employee. Now always remember, when the employer has given it to the employee for use, it is as if the employer is using it for his business or profession, guys. So therefore I can claim depreciation, I can claim normal wear and tear. For how many years now? When did the employer buy it? On the 1st of May 2022. And when is he doing the transfer? On the 1st of August 2024. How many years is this? 1st May 2022 to 30th April 2023, 1 year. Then 1st May 2023 to 30th April 2024, second year. It will be 2 years and a few months, guys, but we take only completed years, right, guys? So therefore for 2 years you will compute normal wear and tear. At what rate now? Tell me. Had it been computer or any electronic items and all, 50% WDV. Had it been a motor car, then 20% WDV. Any other asset, it will be 10% SLM. So 90,000 rupees into 10% SLM basis into how many years, guys? Into 2 years. Be careful, if it is WDV, we'll have to do on WDV basis. This is SLM, so straight away I'm able to compute over here. So 90,000 into 10% into 2, this is going to be 18,000. This is going to be my normal wear and tear. From this I will subtract whatever amount employee has paid to the employer. Employee has paid how much to the employer? 50,000 rupees. So what is the net amount now? The net amount is going to be 22,000 rupees. This is going to be the taxable value of the perquisite. Understanding everybody? Yes. So the main point over here is that you will get normal wear and tear only for that period for which the employer has used the asset for his business or profession. Over here, is the employer himself using the dining table? No, he has given it to the employee for use, right? Till July, employee only was using it. But however, always remember, whenever the employer gives the asset to the employee for use, it is as if the employer is using it for his business or profession, and hence I will allow the normal wear and tear. Okay. And also remember, normal wear and tear always is for the completed number of years only. Okay. So this was your fifth adjustment. Through this adjustment, both use and transfer, both the concepts got revised for you. Now come on, let's go to the next discussion with respect to IFHP. Extremely crucial discussions I have for you over here. Listen to me. See, I'll come to all this. Just give me a moment. First, come to this part, okay? If my assessee is having a house property, that house property will be assessed under the PGBP head only in two situations. Situation number one, when the assessee is self-occupying the property for his business or profession, which means I have a house, I am doing my own business or profession in that house. In that case, that house will be assessed under IFHP. So either I am self-occupying the house for my business or profession. In that case, the house will be assessed under PGBP. Situation 1. Situation number 2, if my business itself is letting out commercial properties, which means my business is to buy properties, give them on rent, buy properties, give them on rent, and mind you, what kind of properties? Commercial properties. Please notice over here, I am not talking about real estate business. Real estate business is different. The business of letting out commercial properties is different, guys. In real estate business, I am buying and selling immovable property. I am buying and selling land and building. But in the business of letting out commercial properties, I am not buying and selling. I am buying immovable property and then I'm giving it on rent. So there are two different businesses. Be very careful. So if my so there are only two situations. There is no confusion at all. There are only two situations wherein the house property will be assessed under PGBP head. Number one, when the assessee is self-occupying the property for his business or profession, and number two, when the assessee is in the business of letting out commercial properties. See, what if he's letting out residential properties? What if he's in the business of letting out residential properties? That will stay under IFHP head only, not PGBP head. But if he's in the business of letting out commercial properties, in that case alone, that particular property will be assessed under the PGBP head. Understanding, guys? Now come on, let's come back to our initial part of the IFHP now. See, this discussion is with respect to those assessees who are into real estate business. Real estate business means what? Real estate business means my business is to buy and sell immovable property. I'm trading in immovable property, which means whatever immovable property I have, it is my capital asset or stock in trade. Not capital asset, it will be stock in trade. Okay, in such cases, whatever income I get from trading these land, building and all, whatever income I get from buying and selling these immovable property, that will go into the PGBP head. But in case I'm getting any rental income, that will come under the IFHP head only, not PGBP head, because just now I told you a house property will go into the PGBP head only in two cases. Tell me, guys, why will it go to PGBP head? Am I self-occupying the property for my business or profession? No. Am I in the business of letting out commercial properties? No. I'm into real estate business. Real estate business is different. Business of letting out commercial properties is different. So if I'm in the real estate business and by chance if I have any rental income, that rental income will stay under the IFHP head only. Understood, everybody? And once you do the IFHP computation, normal usual IFHP computation, guys, nothing extraordinary, nothing special, only one small special point, and that is with respect to vacancy. So when will the special point apply? I'll help you understand. Extremely simple, guys. Condition number 1, assessee should be in real estate business. Condition number 2, because assessee is into real estate business, what is his stock in trade, guys? Land, building, both, they are his stock in trade. I don't care about land over here. I care only about building, because IFHP head, guys, I care about superstructure only. I don't care about land. So condition number 1, assessee is into real estate business. Condition number 2, his stock in trade is building or land and building. Condition number 3 is that he got the construction completion certificate for this building. No, we will see when he got the construction completion certificate. Let's say he got the construction completion certificate on 1st of February 23. Which year is this, guys? This is the year 22-23. Now, what is the end of this year? 31st March 23. From that day, 2 years. In these 2 years, any time in these 2 years, if the property is remaining vacant, any point of time in these 2 years, if the property is remaining vacant, that period during which the property is remaining vacant, the IFHP will be 0. Okay, so my special point will apply if 3 to 4 conditions are fulfilled. Condition number 1, I'm into real estate business. Condition number 2, I'm having stock in trade, which is land, building, or both, but I'm caring about building over here because IFHP head. Condition number 3, I got construction completion certificate. I will see what is the end of the financial year in which I got construction completion certificate. To that, I will add 2 years. In this period, any time, condition number 4, the property is remaining vacant. If all these conditions are fulfilled, then that period during which the property is remaining vacant, in that period my IFHP will be 0. That's all, guys. The small simple new point for you with respect to vacancy. Nicely understood? Yes. Now keep this point in your mind and now come to this question, guys. The question says assessee is in real estate business. Construction completion certificate we got when? On the 1st of February 2023, which means we got the construction completion certificate in financial year 22-23. What is the end of this year? 31st March 23. Plus 2 years will be till 31st March 25. So till 31st March 25, any time if the property is vacant, then I will say IFHP is 0. Why? Are my conditions fulfilled? Assessee is into real estate business. Condition 1, guys. Of course, his stock in trade will be land, building, both. Condition 2 fulfilled, guys. Condition number 3, 2 years from the end of the financial year in which he got construction completion certificate. And condition number 4, till this date, at any point if the property is lying vacant, then the IFHP will be 0. So all my conditions are fulfilled. Therefore, I can say that till 31st March 25, if the property is lying vacant for any period, for that period, the IFHP of that particular property will be 0 in this case. Okay. So he has let out the following. He has let out residential unit, commercial unit, which means he's going to have rental income, guys. Now this rental income, first tell me which head of income, IFHP or PGBP head. No confusion, PGBP head only in 2 cases. Tell me over here, is my assessee self-occupying the property for business or profession? No, he's letting it out. He's not self-occupying it. Then tell me, is your assessee in the business of letting out commercial properties? No, he's into real estate business. Both the businesses are different. So therefore, guys, none of the 2 situations apply. So no PGBP head. I will stay under IFHP head only. Normal, usual computation. Only thing different will be about vacancy. Okay, guys. Now the question says he has let out the following from 1st May 24, which means what happened to April 24? April 24, these units are lying vacant. So tell me, for the April month, will you do any IFHP computation? No. Will you call it vacancy loss and all? No. In the April month, when the property is lying vacant, IFHP will be 0. That's all. See, generally we calculate IFHP for the period for which assessee owns the property, no? And assessee is owning the property for all 12 months over here. So ideally, I'm supposed to calculate for all 12 months. But here, I will not calculate for all 12 months. Why? Because my conditions are fulfilled in the month of April. In the month of April, my assessee is in real estate business. In the month of April, we have some stock in trade, which is land, building, both. In the month of April is falling in this 2 years period. And in that month of April, the property is vacant. So all these conditions are fulfilled. In the month of April, I won't even do any IFHP computation. I will straight away say IFHP is 0 for the month of April. So that is why, do you agree why I've written like this? For April month, is vacant, so IFHP will be 0. So when I'm doing IFHP computation now, I will do computation for only 11 months. And what is the reason? The reason is not vacancy loss. I will not say April month is vacancy loss at all over here. It's real estate business. My 4 conditions are fulfilled. April month, IFHP is 0. So therefore, I will do the computation now only from May to March. Only for 11 months I will do computation. Okay. Alright, guys. Not going too much into the computation right now. I think we can straight away go to the concept now. See, listen to the next concept now. We are right now in the 7th concept. See, my assessee is having a residential house property. He is self-occupying the residential house property for his own residence. So this property will be assessed under which head? IFHP head only, guys. Then what if I let out a residential property? It will stay under the IFHP head only. No confusion. I'll go to the PGBP head only in these 2 situations, in no other situation. Okay. Then look at the next one. Assessee is in the business of buying and selling residential house properties, which means assessee is in real estate business, guys. So if assessee is in real estate business, trading income will go to the PGBP head. But in case he has any rental income, that will come under IFHP head. Normal, usual computation only. The only special point with respect to real estate business is if those 4 conditions are fulfilled, if the property is vacant at any time during those 2 years after the construction completion certificate is obtained, then in that case, for that period, the IFHP will be 0. So IFHP computation will be normal for real estate business. Only unique point is if those 4 conditions are fulfilled. Okay. Then assessee is in the business of letting out residential properties. He is in the business of letting out residential properties. His rental income will go to which head? Correctly tell me, guys. He is in the business of letting out residential properties. His rental income will stay under IFHP only, because when do I put it under PGBP? Only if he is in the business of letting out commercial properties. So therefore, can I say, guys, residential properties will always stay under IFHP head only. It will never go to the PGBP head. Residential property. Doesn't matter what business assessee is doing. This is like one shortcut for us, that residential house property will always stay under the IFHP head only. No exception for this. Okay, now come to this last part over here. In this question, if the assessee was in the business of letting out properties, then what will happen? If the assessee is in the business of letting out properties, then in that case, if he is letting out residential properties, that will still stay under IFHP only. No change. But what will happen to the commercial units? From the commercial units, whatever rent he is getting, that rent as it is will go under PGBP. See, here you will not do municipal value, fair rent, standard rent, whichever is higher, whichever is lower, GAV, all that you will not do. If assessee is in the business of letting out commercial properties, from these commercial properties, whatever rent he gets, like for example, let's say 20,000 rent he got per unit, 5 units he has. For 11 months he got this rent. This rental amount as it is, it will go under PGBP. No other extra drama, no IFHP. Like in IFHP, you do the 6 steps to find GAV, all that you will not have. No pre-construction interest. Pre-construction interest concept is only IFHP head concept. Pre-construction interest you don't have in PGBP and all. So therefore, if your assessee is in the business of letting out properties, if he's in the business of letting out residential properties, that will still stay under IFHP only. But if he's in the business of letting out commercial properties, that alone will go under the PGBP head. Straight away the rental income as it is, dump it into the PGBP head. No extra drama, no extra calculation. Okay guys, now come to our next discussion. Our next discussion is about our PGBP head. Now under PGBP, I need to focus a little bit on the depreciation part. See what will happen if the assessee sells away a depreciable asset. I'll put it for you over here. Okay, see, if the assessee sells a depreciable asset, the first thing you will check is the block empty or is the block not empty. If the block is empty, no depreciation calculation, guys. You will straight away go to capital gains. In capital gains, either you will have STCG or you will have STCL. You don't care about the period of holding and all, either STCG or STCL. Okay, but however, if the block is not empty, okay, then in that case, first you will try for depreciation. If depreciation is possible, great. But if depreciation is not possible, then only you will come to capital gains computation. In that case, you will have STCG only, no STCL. Okay, so if the block is empty, then in that case, you will not compute depreciation. You will straight away come to capital gains computation, where you can have gain or loss. But if the block is not empty, then you will first try depreciation. Only if depreciation is not possible, only then you will come to capital gains, and in capital gains STCG only is possible. In this case, STCL is not possible. Okay, now come on, let's work out one question on this part. Okay, the question says, let's read the question. It says that Messrs. Aditya Traders, a sole proprietorship concern, owns 4 machines that were first put to use for business purpose in March 2024. Then the question says the depreciation. One second. Then the question says the depreciation on these machines is charged at 15%. The WDV of the block on 1st April 24, opening WDV they have given to us, it is 7,70,000. On 15th July 24, it sold 2 of the machines. Total how many machines it had in the beginning of the year? 4 machines. I sold how many machines? I sold 2 machines only. So is my block empty? Block is not empty, guys. So if the block is not empty, first I will try for depreciation. Okay. On 30th December 24, it acquired a second-hand plant for 6,10,000 and put it to use for business purpose. So in the beginning of the year, I had 4 machines, let's say A, B, C, D. Then assessee sold 2 of them and assessee purchased 1 more. Okay, this is the situation. Determine the claim of depreciation. Come on, let's begin. I will start with my opening WDV on the 1st of April 24, guys. The opening WDV is 7,70,000. Then to this, I will add actual cost of assets acquired. Have I acquired any new asset during the year? Yes, I have acquired a second hand plant. I have acquired it for 6,10,000. Whenever you acquire a new asset during the year, two things you check. Number one, did you put it to use for at least 180 days? See guys, it was put to use only on 30th December 24. So definitely it is put to use for less than 180 days. So you will get only half year's depreciation. And then you will check, will I get additional depreciation? Second hand plant guys, no concept of additional depreciation for second hand plant. Okay, then from this you will subtract monies receivable for assets sold. You have sold the assets for 10 lakh rupees. You will subtract the monies receivable for assets sold. So what is your closing WDV on 31st of March 25? Your closing WDV will be 3,80,000. Okay, then this closing WDV number, I've taught you that we split this number into three parts guys. Part A, out of the new assets that we have purchased, is there any asset which we have put to use for 0 days? Any new asset which we put to use for 0 days? In this question, no. Then out of this new asset purchase, do you have any asset which was put to use for less than 180 days? And then finally, it is your balance WDV. This is how we split our WDV into three parts guys. On this less than 180 days part, we get only half year's depreciation. On this balance WDV, we get full depreciation. This is how we do it. Now tell me, do we have any new asset purchased which was put to use for 0 days? No. Do we have any new asset purchased which was put to use for less than 180 days? Yes, 6,10,000. But tell me, can I write full 6,10,000 over here? No, because I have only 3,80,000 WDV left. So whatever I have, that alone I will write over here. And do I have any balance WDV left over here? No. So on this 3,80,000, my depreciation is going to be 15% into 1 by 2. Why 1 by 2? Because put to use for less than 180 days. So this is going to be how much? 28,500. This is your normal depreciation. No additional depreciation guys, because it is second hand plant and machinery. We've already concluded that. So what is going to be your opening WDV for the next year? Opening WDV will be 3,51,500 for the next year. Okay, so this was pretty simple. The only catch over here was we remembering to split the WDV into three parts. Do we have any new asset that is purchased that we've put to use for 0 days? No, because if we have any such asset, on this asset no depreciation. Then do we have any asset which we have purchased during the year which is put to use for less than 180 days? Yes, 6,10,000. But I can't write full 6,10,000 over here because I'm left with only 3,80,000 of WDV. So whatever I'm left with, that alone I will write over here on that 15%. On that only half year's depreciation I will claim because put to use for less than 180 days. Okay, so they're asking us what is the depreciation amount. See, be careful. Silly mistake in the examination possible is that we might end up taking the opening WDV number to our P&L. Be careful. This is your opening WDV number. This is the depreciation number. It is this number which you will take to your PGBP. So what is the depreciation amount? The depreciation amount is 28,500. Do you have any capital gains guys? No. Even though we did sell some assets during the year, I did not find the need to compute capital gains because block is not empty. If the block is not empty, I will first try for depreciation. Only if depreciation is not possible, only then I'll go to capital gains. Here depreciation was so easily possible. So if depreciation is possible, then no capital gains. So do I have any capital gains over here? No, I don't. And lastly, if Messrs. Aditya Traders had sold the two machines in July 24 for 15 lakhs, will there be any difference in your working? Which means instead of 10 lakh selling price, what if the selling price was 15 lakhs? Then what would happen? Come on guys, let's see. If the selling price was 15 lakhs instead of 10 lakhs, then what would the closing WDV number be? The closing WDV number will become a negative number now. It will become a negative number. If it's a negative number, any depreciation is possible? No guys, in that case, no depreciation is possible. Now understanding, my block is not empty. I first tried for depreciation, but my closing WDV is a negative number. Because it's a negative number, depreciation is not possible for me. So because depreciation is not possible, now I will try capital gains guys. Yes, so come on. How will you do capital gains computation now? What's the full value consideration? You sold the machinery for how much? For 15 lakhs. No expenses on transfer. This itself becomes net consideration. From this we will subtract cost of acquisition. You know very well in depreciable asset cases, the cost of acquisition will be what? The cost of acquisition will be opening WDV plus additions, right guys? So what is your opening WDV over here? 7,70,000, 7,70,000 plus 6,10,000 additions, 13,80,000. This will become your cost of acquisition. What's your net number now? Your net number 1,20,000. This will become your STCG. Always short term only. Depreciable asset will always be short term only. We don't care about the period of holding. Understanding? So my block was not empty. I first tried for depreciation, but my closing WDV became negative. Depreciation was not possible. So because depreciation was not possible, I came to capital gains, and in this capital gains computation, I can't have a loss. It has to be a gain only. Okay, that's what we did over here. Don't forget, in depreciable asset cases, what will your cost of acquisition be? Opening WDV plus additions. Okay, so this was your eighth concept. Now come to the ninth concept with respect to capital gains, guys. I want to do this computation for you, so I'll erase this. One quick reminder of section 54F. Have a look at the question. In August 2024, Mr. Aryan transferred a plot in Chandigarh for 70 lakhs. So what is August 2024? The date of transfer. What is the asset we're talking about? A plot. He transferred it for 70 lakhs. This becomes your full value consideration, which was acquired by him in May 2016. So May 2016 is his date of acquisition. It is well after 1st April 2001. So you don't have to revise the cost of acquisition also. He had purchased it for 22 lakhs. This becomes your cost of acquisition. He paid brokerage 1% on transfer. So we have expense on transfer. And then later, in May 25, he acquired a residential house property in Kanpur for 40 lakhs. So this part, one second. This part, I'll keep it pending. This part will come to it towards the end of the computation. Okay, so let's begin a computation, guys. What are we transferring? Capital asset being transferred is plot. We purchased it in May 2016. We are transferring it in August 2024. The date of transfer is clearly after the amendment. It is on or after 23rd July 2024, guys. So therefore, the new provisions only will apply. Okay, now what's the full value consideration over here? Full value consideration is 70 lakhs. In full value consideration in capital gains, only two adjustments are possible. Either section 50C or 50CA. Be careful. Here, none of the two adjustments are possible because you've not given any information. Expenses on transfer 1% on 1%. So 70 lakh into 1%, 70,000 will be your expense on transfer. So your net consideration will be 69,30,000. Be careful, guys. In expense on transfer, what mistake is possible? In case section 50C is applicable, in case you end up taking the SDV number over here, then expense on transfer, don't calculate 1% of the SDV number. It will become wrong. Expense on transfer, 1% will always be of what? Your actual full value consideration, guys. That silly mistake is possible. Be careful. Okay. Then cost of acquisition, will you do indexation? No, because the transfer happened after the amendment, and you can't apply the grandfather clause also because it is not shares, guys. It is immovable property. So cost of acquisition, I'll take it as it is, 22 lakhs. No cost of improvement. So what is your LTCG number now? 69,30,000 minus 22 lakhs. 47,30,000 will become your LTCG number. Then section 54F exemption by, because see, assessee is an individual or HUF. Assessee has transferred any long-term capital asset other than residential house property. Assessee is buying a residential house property in India, guys. So your conditions are getting fulfilled. Therefore 54F you will get. Now just before you can do the computation, see, you should buy the asset within time limit. What is the time limit? You should buy the new house. Either you will buy or you will construct. If you're buying, you should buy 1 year before transfer or 2 years after transfer. If you're constructing, you must complete the construction within 3 years after transfer. Over here, if you see, the transfer happened when? In August 2024. We are buying the new asset when? In May 2025. So yes, we are buying it within 2 years from the date of transfer. Also, we are buying it within 139 burn date. So CG account concept also will not apply. So straight away I will do the 54F computation. So what's the formula? What is the amount invested in the new house? 40 lakhs into the LTCG number, which is 47,30,000, divided by your net consideration number, which is 69,30,000. So how much will you get? Your 54F exemption will be 27,30,159. So your LTCG now will be 19,99,841. This will be your LTCG number. Understanding? So on the day of the examination, I wanted to remind you about 3 to 4 things over here through this question. Thing number one: in your capital gains in full value consideration, only two adjustments are possible. One is section 50C for removable property, other is 50CA for unlisted shares. Second point that I wanted to remind you: expense on transfer, be careful, it's always a percentage of the actual consideration. Point number three: remember, if 54F if 54F is applicable, don't forget the formula. Don't straight away take the number. Don't forget the formula. Don't make a silly mistake over here. Okay, guys. Now, come to the next discussion, which is about rights shares. Now, the question says Mr. Kishan also holds 1,000 shares in Venus Limited, an unlisted company, which he acquired in the year 2001-2 at a cost of 75,000 rupees. In April 2024, the company offered him right shares at 160 rupees per share in the ratio 2 shares for every 5 held. Be careful. How many shares he's holding originally? 1,000 shares. This is his original shares, guys. These shares he had acquired in 2001-2. This becomes his date of acquisition. Even this is after 1st April 2001, so you don't have to revise the cost of acquisition. His cost of acquisition is 75,000. Okay. Then in April 2024, the company offered him rights shares at 160 rupees per share in the ratio 2 for every 5 held, which means how many shares should he hold? 5. How many rights shares will he get? 2. How many shares does he actually have? 1,000. So how many rights shares he will get now? He will have the right to buy 1,000 into 2 by 5. He will have the right to buy 400 rights shares, guys. But however, the question says Mr. Kishan decided to retain only half of the right. So only 200 rights shares only he is going to buy. He is renouncing the remaining rights in favor of Mr. Kush for 30 rupees per share. So in this question until now, there are 3 things. Number 1, he is having original shares, guys. Original 1,000 shares he is having. Then he's exercising the right and he's buying how many rights shares? 200 rights shares. The question says half he's exercising. So 200 rights shares he's buying, and then he is renouncing the right to buy the balance 200 shares at 30 rupees per share in the favor of Mr. Kush. Later, all the shares were sold by Mr. Kishan. How many shares, guys? All the shares means how many shares? Original shares he's having 1,000 shares. Rights shares he's having 200 shares. Total 1,200 shares he has sold to at 300 rupees per share on 15th July 24, while Mr. Kush has sold all his shares in December 2024 at 280 rupees per share. We'll come to Mr. Kush later. Let's talk about Mr. Kishan first. So when it comes to Mr. Kishan, guys, there are going to be totally 3 things: original shares, rights shares, and renunciation. So we'll have 3 different computations for Mr. Kishan. One is for the original 1,000 shares, then for his right shares, 200 right shares, and then renunciation. Okay, now what is a full value consideration? For how much is he selling the shares? He is selling all the shares at 300 rupees per share. So 300 into 1,000, 3 lakh is a full value consideration for original shares. 300 into 200, 60,000 is the full value consideration for the rights shares. And what about the renunciation? He's renouncing 200 rights in the favor of Mr. Kush for 30 rupees per share. So 200 rights into 30 rupees per right, 6,000 rupees. Question doesn't talk about expense on transfer. This itself becomes net consideration. Be careful, over here the transfer has happened on 15th July 24, which means the transfer has happened before 23rd July 24. So indexation and all will apply over here. Okay. And also if you see, it is unlisted shares. So the period of holding is definitely more than 24 months over here. For the renunciation, I don't care about the period of holding, guys. It will always be short term only. Alright. So I'll straight away come to the cost of acquisition step. I'll index the cost of acquisition because the transfer happened before amendment. So for the original shares, I purchased them at 75,000. So 75,000 into CII of the year of transfer, 363 divided by CII of the year of acquisition, 2001-2, guys. 2001-2, the indexation is 100. 75,000 into 363 by 100, which is 2,72,250. For rights shares, are these also long term? Let us check. Where did we hold them also for 24 months? Let us check. In April 24 only, the company gave him the rights shares. He's selling them in July 15th, 2024, which means rights shares are short term over here, guys, less than 24 months. So, for because it's short term, I will not index the cost of acquisition for rights shares. I'll subtract the cost of acquisition as it is without indexation. Understood? I got them only in April 24. I'm transferring them on in July 15th, 24. Less than 24 months I've held them. So therefore, rights shares will be short-term capital asset for me. So I will not do indexation and all. I got these rights shares for how much? 160 rupees per share, guys. So 160 per share into 200 shares, 32,000 will be the cost of acquisition. For renunciation, cost of acquisition is 0. For renunciation, only two things you have to remember, guys. One is they will always be short term only, and number two, cost of acquisition will always be 0 only. Okay, so that's it. What is your long term capital gain now? LTCG 3 lakh minus 272 250, you will get 27,750. This is your long term capital gains. And what is your short term capital gain? 60,000 minus 32,000 for your rights shares. 28,000 is short term capital gain. Also, this renunciation 6,000, even this is going to be your short term capital gain. Renunciation always short term capital gain only. Renunciation always cost of acquisition 0 only. Okay, so now what's the total LTCG for Mr. Kishan? Total LTCG is 27,750 and total STCG will be 28,000 plus 6,000, which is 34,000. Now this was a computation for whom? For Mr. Kishan. Now what about Mr. Kush? Let's talk about him now. When it comes to Mr. Kush, what did he do? See, he bought the right to buy rights shares from Mr. Kishan. He did not buy the shares from Mr. Kishan. He bought the right to buy the rights shares from Mr. Kishan. Right, guys? Kishan has renounced the rights in his favor. Right? So, when Kishan renounced means what? Kishan is not selling the share to Mr. Kush. No. Kishan is only giving to Mr. Kush the right to buy the shares. Okay, so Mr. Kush has bought the right to buy the shares from Mr. Kishan at 30 rupees per share, and then he has bought the 200 shares from the company at 160 rupees per share. And Mr. Kush is now selling away the shares at 280 rupees per share in December 24, guys. So Mr. Kush is selling the shares on or after 23rd July 2024. So therefore, the amended provisions will apply. So if I talk about Mr. Kush, what is a full value consideration? For how much is he selling away his 200 shares? He's selling at 280 rupees per share. So 200 shares into 280 per share, 56,000 is a full value consideration. No expenses on transfer. This itself becomes your net consideration. From this cost of acquisition, I will subtract. I won't index it, guys, because of two reasons. Number one, it is after the amendment, and number two, it's short term. He acquired it only in the month of April, in the month of May, and he's transferring in December. So definitely he has held it for less than 24 months. So therefore, short term capital assets. So I'm not going to index. The most important point over here is what will be his cost of acquisition. See, he will have two costs over here. Mr. Kush has first paid 30 rupees per right to Mr. Kishan. Then he has to pay to the company how much? To the company per rights share is 160 rupees per share. So for Mr. Kush, the cost per share will be 190. This into 200 shares. So this total cost of acquisition will be 38,000. So for Mr. Kush, his short-term capital gains will be 18,000. Understood, everybody? Yes. So this was the reason. You understood why I wanted to calculate the rights share for you. The reason was that main point, I wanted to first of all tell you that when you renounce the right, then your cost of acquisition will always be 0. Capital gains will always be short term. Don't do period of holding and all. Always straight away short term only. Then the person to whom you are renouncing the right, for him, he will have two costs. 30 rupees he paid to Kishan, 160 rupees he paid to the company, so he will have two costs. Okay, so these were the 10 most important points I wanted to discuss with you first before I go into the total income adjustments, guys. So I'll just give you one quick revision of all the points I've discussed with you till now. Yes, I'm giving you a revision of the revision. Listen carefully. My first point was the business is in Iran, controlled from Delhi. Source of the income is outside India. Business is in Iran. Business is outside India. So source is outside India. Controlled from Delhi is relevant only for RNOR. Second point we had learned, when it comes to interest royalty FTS, the whole focus is on who the giver is. Giver is non-resident. Your first answer will be accruing outside India. Non-resident plus interest, only one exception you have, is a loan being used for business or profession in India. If yes, then you will say that it is accruing in India, otherwise accruing outside India. Okay. Then in salaries, when it comes to employers' contribution to RPF, up to 12% of salary it is exempt. Beyond that, excess is taxable. But also don't forget this point, employers' contribution to RPF plus superannuation fund plus NPS put together, if it is more than 7,50,000, you will find the excess. The excess will be taxed as a perquisite under salaries head. Also, interest on the excess will also be taxable as perquisite under the salaries head. Then professional tax, two adjustments over here. Whatever amount is paid by the employer will be a taxable perquisite for me. Then the total professional tax paid, whether paid by employer, whether paid by employee, put together, total professional tax paid, I will get section 16 deduction, but only and only if I am opting out of 115 BAC. Okay. Then gift that employer has given to employee, cash gift fully taxable, gift in kind up to 5,000 exempt. If it is more than 5,000, I will either tax the excess or I will tax it fully. Okay, and don't forget, even gift voucher will be considered as gift in kind. All right. Then use and transfer of movable asset, you understood, right? We did the whole computation also over here. When there is use of movable asset, what is the employee using the asset for doesn't matter. That doesn't matter. Straight away 10% per annum you will do the computation. But if the use perquisite is only for a part of the year, then proportionate calculation don't forget to do. Okay, when it comes to transfer, be careful, you will compute normal wear and tear only for those years for which the employer has used the asset for his business or profession. But however, if the employer has given the asset to the employee for use, it is as if the employer himself is using the asset for business or profession. Okay, and also one more thing, normal wear and tear over here is calculated only for completed years. Okay, even leave salary, your completed years, you ignore the fraction. Even over here we ignore the fraction. Gratuity also not covered by POGA, we ignore the fraction. Only gratuity covered by POGA, there only we consider the fraction. Okay, then after this, a very important discussion we had with respect to IFHP. Only in two situations my house property will go to PGBP head. Number one, self-occupied for business or profession, and number two, when the business of the assessee is letting out commercial properties. Only in these two cases my house property will go to PGBP. One conclusion we made, residential property will always stay under IFHP only. Then we learned if assessee is in real estate business, in case he has any rental income, it will stay under IFHP head only. Normal computation. Only one new thing over here was that if these four conditions are fulfilled, assessee is in real estate business, stock in trade is land or building, then once a construction completion certificate is obtained from the end of the year plus 2 years, in that period, any time if the property is vacant, for that period IFHP is 0. Don't call it vacancy loss and all, straight away call it as IFHP 0. Okay, then after this our next learning was, yes, in case assessee is in the business of letting out commercial properties, the rental income will go to PGBP. Don't do computation and all, straight away whatever is a rental income, take it and dump it into the PGBP head, story over. Okay, then we learned what if the block is empty. Then we learned what if the assessee sells away a depreciable asset. You will check, is a block empty or is a block not empty. If the block is empty, no depreciation calculation, guys. Straight away you will come to capital gains. Either you will have STCG or you will have STCL. But if the block is not empty, you will first try depreciation. If depreciation is not possible, like in our example we had a negative WDV number, depreciation was not possible, then go to capital gains computation, and in this case capital gains will be gain only, can't be a loss. Okay, and also one more thing, don't forget, in your capital gains computation for depreciable asset, cost of acquisition will be opening WDV plus additions. Okay, then section 54F, I wanted to remind you, amount invested into LTCG by net consideration. Don't forget to check CGD concept, guys. Don't forget CGD concept. You should purchase the asset not only within the time limit, you should also purchase it within your 139 1 date. Only then you will get exemption. If you want to purchase after the 139 1 date, then you better put the money in CGD. And if you're putting the money in CGD, you have to put the money in CGD when? Within the earlier date, only then you will get the exemption. Okay, FVC, don't forget, two adjustments are possible over here. One is your 50C and the other is 50CA. Expense on transfer, don't forget, whatever is a percentage, it will be a percentage of the actual consideration, not the SDV number. Alright, then our last discussion was with respect to rights shares, that with respect to renunciation, the cost of acquisition will always be 0. It will always be short term only, point number 1. And point number 2, the person to whom we are renouncing the right, for him, he will have two costs. 30 rupees which he paid to Kishan and 160 rupees which he has paid to the company. Okay, now coming to the next point, guys, this is relating to life insurance maturity proceeds, for which I put one detailed SOS video also, which I hope you've watched. Let's read the question. The question says, Mr. Rohan took a life insurance policy on the 10th of May 2014. Sum assured 18 lakh rupees, annual premium is 1 lakh 50,000 rupees. So sum assured 18 lakh, annual premium is 1 lakh 50,000. Policy is taken on 10th May 2014. The policy matured on 9th May 2024. 22 lakh is due to receive by him. What will be the tax treatment of the maturity proceeds? Now, maturity proceeds, remember I taught you total 6 situations. Only in 4 situations only the maturity proceeds will be taxable. What are the 4 situations? If it is KMIP, here it is not KMIP. Then if it is section 80DD policy, here it is not 80DD policy. Then after that, 2 more situations you have. The first one is where it is none of the 4 situations, which means it is not KMIP, it is not section 80DD policy, it is not term life insurance policy, also money is not received upon death, and the premium happens to be more than the limit, guys. Tell me, is the premium more than the limit over here? The limit depends upon the date of the policy. Policy is taken on 10th May 2014. Policy is taken on or after 1st April 2012. So the maximum premium can be 10% of sum assured. 10% of 18 lakh will be 1 lakh 80,000. My premium is 1 lakh 50 only, guys. It is within the limit. So is the premium more than the limit? No. So even this situation will not apply. The last situation is that, again same thing, none of these 4 situations apply. That is, it is not KMIP, it is not 80DD policy, it is not term life insurance policy, and money is not received upon death also. The premium is within the limit. Yes, the premium is within the limit, guys. The policy is taken on or after 1st April 2023 and the aggregate premium is more than 5 lakhs. But here, see, was a policy taken after 1st April 23? No, it was taken on 10th May 2014. So it was not taken on or after 1st April 23. Even this situation will not apply. So if none of these situations apply, that's all, the proceeds will be exempt. Only in these 4 cases only the proceeds will be taxable. All other cases proceeds will be exempt. I'm not going too much in detail because I've explained it to you very nicely in the SOS video. So I'm hoping you've watched that, and with that assumption, I'm solving this question for you. Okay, only if it comes under any of these 4 situations, only then the maturity proceeds are going to be taxable. But if it is not coming under any of these situations, then the maturity proceeds will be fully exempt under section 10(10)(d). Alright, then after this, listen to my next discussion with respect to dividend. See, when it comes to dividend, you will see that which company is giving you the dividend. If dividend is from an Indian company, no need to check anything else. You will straight away say that this dividend income accrues in India. If it accrues in India, guys, it becomes an Indian income, and if it's an Indian income, it will be taxable for all the assessees. But if the dividend income is from a foreign company, doesn't matter where is this foreign company's place of effective management, doesn't matter whether the foreign company is having a place of business in India or not, doesn't matter all that. If the dividend income is from a foreign company, you will straight away say that the dividend income accrues outside India. If it accrues outside India, don't straight away conclude it is foreign income. No, don't do that silly mistake. Check where is the income received. 2 possibilities now. Either it will be received in India or it will be received outside India. If it is accruing outside India but received in India, then it will become an Indian income, guys. It will be taxable. If it is accruing outside India but received also outside India, then it will become a foreign income. It will be taxable only for ROR SSE. Okay, and with respect to dividend income, also don't forget only one expense you can subtract, and that is interest expense, and that to maximum how much you can subtract, 20% of the dividend income. But see section 222F dividend buyback cases, there no expense is allowed, even this interest also is not allowed. Okay, so in buyback, in section 222F dividend, over there no expense you can subtract, even this interest 20% you can't subtract. Other cases 222A, B, C, D, other dividends you can subtract only one expense, which is interest expense, that to maximum 20% of dividend income. That's the maximum you can subtract. Okay, then comes our 13th point about buyback, guys. I wanted to give you a proper revision of buyback because I really think that you will be having a buyback question in the examination. The reason why I'm saying it is because you had an adjustment on buyback in your RTP also, in your mock test paper also, your September 24 examination mock test also, RTP also. So that is why I think it's highly probable. So that is why I want to give you a quick revision of buyback, both before amendment also, after amendment also. So for buyback, the amendment date relevant is 1st October 2024. Listen carefully, okay? There's this one person, Mr. Aryan. He is holding 20,000 shares of Alpha Limited Limited, an Indian company. He purchased these shares on 1st Jan 2016, date of purchase. He purchased them at 200 rupees per share. How many shares? 20,000 shares. Okay. They were acquired through a stock exchange, listed shares, guys. STT was paid both at the time of acquisition and sale. Alpha Limited decided to buy back 50% of its shares. So Aryan is holding 20,000 shares. 50%, 10,000 shares will get bought back at 250 rupees per share. 250 rupees per share becomes the buyback price. Alpha Limited bought back proportionate shares of Mr. Aryan. FMV of equity shares on 31st Jan 2018 is given to us. Okay, so Mr. Aryan is having totally 20,000 equity shares. Out of this 50%, 10,000 equity shares company is going to buy back at 250 rupees per share. Originally, when he purchased the shares at 200 rupees per share in Jan 2016. FMB on 31st Jan 2018 they have given to us. Okay, now see, in case the buyback happened before amendment, before 1st October 24, for the shareholder there will be no tax implications, guys. Tax implication will be for the company only before 1st October 24. What tax implication? Company will have to pay buyback distribution tax at 20% of distributed income plus mandatory 12% surcharge plus mandatory 4% cess. Okay, 20% of distributed income plus 12% surcharge plus 4% cess. And what is distributed income? Distributed income is nothing but buyback price minus issue price. This whole computation you will do from whose point of view? From the company's point of view. So if the buyback happened before amendment, for the shareholder there will be absolutely no tax implication. All tax implication will be for the company only. For the company there will be buyback distribution tax at what rate? At the rate of 20% of the distributed income plus mandatory 12% surcharge, mandatory 4% cess. I'll repeat once again, what is distributed income? It is nothing but buyback price minus issue price. Long back when the company had issued the shares, company issued the shares for how much? That is issue price minus buyback price. In our example, buyback price is 250 rupees per share. So this is your distributed income. On this distributed income, 20% tax plus mandatory 12% surcharge plus mandatory 4% cess. This is how you will compute if the buyback happens before 1st October 24, guys. But however, if the buyback is happening after on or after 1st October 24, new provision, company no tax implication, full drama for shareholder only, and two heads of income will be involved, guys. IFOS and capital gains. Listen. I'll give you another light bulb moment over here. Capital gains plus IFOS. This combination, where else you have? In liquidation. Even in liquidation, 222C dividend, IFOS and capital gains. Similarly, in buyback also you have this combination of capital gain plus IFOS. In IFOS, 222F dividend and capital gains. Okay, so let's think now from Aryan's point of view. Let's do the computation. The buyback has happened after the amendment. First of all, IFOS. Under IFOS section 222F, whatever buyback price he is getting, as it is taxed over here, no expense adjustment, nothing. How much buyback price is he getting? 10,000 shares are getting bought back, guys. Per share, the buyback price he's getting is 250 rupees per share. So 10,000 shares into 250 rupees per share, this is going to be what? 25 lakh rupees. This 25 lakh rupees as it is will become IFOS 222F dividend. No expense is allowed to be subtracted over here. Story over. Then comes capital gains. You will do the usual thinking. Capital asset transferred over here is listed shares. STT paid both at the time of purchase and transfer. Definitely the period of holding is more than 12 months over here. Long-term capital asset. STT is also paid both at the time of purchase and transfer. 112-week case, guys. 112-week case this would be. This you will be able to identify. You know the whole sequence of thinking very well. I have taught you that very nicely. We've done good number of questions on all that. So applying that sequence of thinking, you will conclude that 112 will be applicable for us. Okay. First of all, IFOS. Under IFOS section 222F, whatever buyback price he is getting, as it is taxed over here, no expense adjustment, nothing. How much buyback price is he getting? 10,000 shares are getting bought back, guys. Per share, the buyback price he's getting is 250 rupees per share. So 10,000 shares into 250 rupees per share. This is going to be what? 25 lakh rupees. This 25 lakh rupees as it is will become IFOS 222F dividend. No expense is allowed to be subtracted over here. Story over. Then comes capital gains. You will do the usual thinking. Capital asset transferred over here is listed shares. STT paid both at the time of purchase and transfer. Definitely the period of holding is more than 12 months over here. Long term capital asset. STT is also paid both at the time of purchase and transfer. 112-way case, guys. 112-way case this would be. This you will be able to identify. You know the whole sequence of thinking very well. I have taught you that very nicely. We've done good number of questions on all that. So applying that sequence of thinking, you will conclude that 112 will be applicable for us. Okay, now coming to the computation, full value consideration will be 0, guys, always in buyback cases. Why? Because assessee is getting the buyback price, no doubt. I have already taxed it in IFOS. I can't tax it once again in capital gains. So full value consideration will always be 0 only. We don't have any expense on transfer. Net consideration is 0. What is the cost of acquisition? Cost of acquisition, we always think about two things. We have a rule. We pause, check and think. Two things we check over here. Number one, will I get any indexation benefit? No indexation benefit, guys, because buyback is happening on 1st October 2024, which is on or after 23rd July 24, after amendment. So no indexation. Then I will also check, is it long-term capital asset plus 112A plus date of acquisition, is it on or before 31st Jan 18? Yes, all these conditions are fulfilled. It is a long-term capital asset. It is 112A. Date of acquisition is before 31st Jan 18. Therefore, grandfather clause will apply, guys. And what does grandfather clause say? Grandfather clause says cost of acquisition will be whatever is the actual cost of acquisition, that number, or the FMV on 31st Jan 18, or the full value consideration. Right, guys? So what is the FMV on 31st Jan 18? 190 rupees per share. What is the full value consideration? Full value consideration is 0. So out of these two numbers, we pick whichever is the lesser number, which is going to be 0. Then actual cost of acquisition is how much? Actual cost of acquisition is 200 rupees per share. Out of these two numbers, we pick whichever is the higher number, which is 200. So my cost of acquisition will be 200. So 10,000 shares into 200 rupees per share. 20 lakhs is my cost of acquisition, no cost of improvement. So 20 lakhs long-term capital loss I will have. Understanding? Grandfather clause, can I give you a revision once again? When do we apply the grandfather clause? If it is long-term capital asset plus 112A plus date of acquisition on or before 31st Jan 18, in that case your cost of acquisition number will change. Your cost of acquisition number will now be your actual cost of acquisition or the FMV on 31st Jan 18 or your FPC number. So out of these two numbers, whichever is lesser, and out of these two numbers, whichever is higher, this will be your revised cost of acquisition. And here they can also give you an adjustment where your shares you purchased before 1st April 2001. So in that case, your actual cost of acquisition also will change. You will take FMV on 1st April 2001 over here. So this was your grandfather clause. All right, so the point is, in buyback after amendment, for company no tax implications, no buyback distribution tax and all. For shareholder there will be two tax implications. One will be under IFOS, second will be under capital gains. Under IFOS, whatever buyback price you're receiving, as it is, I will tax it for you under IFOS. Under for the purpose of from the point of view of capital gains, remember that full value consideration will always be 0, so you will always have a negative number only with respect to capital gains in buyback cases. Okay, so we completed learning 13 concepts, guys. Now come to the 14th concept. This is with respect to clubbing wherein the transaction relates to house property. Okay, in this situation you will first think about deemed owner. Now when can you apply the deemed owner concept? In two situations. Situation number one, the assessee has transferred the house property to his spouse for no consideration or for inadequate consideration, but it should not be under an agreement to live apart. If it is under an agreement to live apart, neither a deemed owner concept will apply nor clubbing concept will apply. Nothing will apply. Okay, the second transaction is when assessee has transferred the house property to his minor child for no consideration or for inadequate consideration. Be careful. If the assessee is transferring house property to his minor married daughter, then in that case the deemed owner concept will not apply. Instead, the clubbing concept will apply. In deemed owner concept, you don't have section 1032 exemption, that 1,500 rupees per child exemption you don't have in deemed owner concept. But But in clubbing concept, you do have the 1032 exemption of 1500 rupees exemption per child. But also don't forget that this exemption you will get only if the assessee has opted out of 115 BSE. So multiple small points I'm trying to give you a revision over here, trying to just refresh your memory, understanding. First I will try deemed donor. Only if deemed donor is not possible, I'll come to clubbing. Deemed donor concept I will apply only in two relations, assessee to spouse and assessee to minor child. Minor child should not be minor married daughter. If it is minor married daughter, deemed donor concept will not apply, but clubbing concept will still apply. Okay guys, and also don't forget, if assessee is transferring a house property to his son's spouse, then you will not apply the deemed donor concept guys, you will apply the clubbing concept only. Okay, because deemed donor concept is only for assessee to spouse and assessee to minor child. If assessee is transferring to son's spouse, deemed owner concept will not apply, clubbing concept only will apply. Alright, so this was your concept number 14. Now coming to the next concept, concept number 15. This one is with respect to set off and carry forward. I had to discuss 2 points with you. One is speculative business loss. So speculative business loss I can adjust only against speculative business income guys, and it will have a life of only 4 years, right? Then and by the way, how will you identify it as speculative business? If the question says it is derivatives are not considered as speculative transaction guys. But however, if the question says that we did not take delivery of goods, or let's say intraday trading of shares, all this will become speculative. Okay, but buying and selling derivatives, trading in derivatives will not be considered as speculative business. However, if the question says we did not take delivery of shares or intraday trading of shares, this will be considered as speculative. So speculative business loss can be adjusted only against speculative business income, and it will have a life of 4 years. Then STCL can be adjusted against STCG also, against LTCG also, but LTCL can be adjusted only against LTCG. You just can't forget this, okay? And remember that both have a life of 8 years. Then listen to the next point guys. If the question says assessee has made a payment to central government health scheme, it will come to section 80D. Under 80D, I always make you draw 2 columns, right? Family category and parents category. Central government health scheme will come under the family category. So 80D, family category. Okay, and don't forget, under 80D doesn't matter what is the amount of payment, the payment has to be always made in non-cash mode only. Every payment in 80D has to be made in non-cash mode only. Only preventive health checkup only you can pay in any mode, whatever mode you want, and preventive health checkup internal limit of 5,000, don't forget. And also don't forget, in section 80D you have the medical expense point. In medical expense point, the patient has to be a senior citizen or a super senior citizen. The patient has to be either under the family category or under the parents category. In that patient's name, you should not be having any medical insurance policy. If all these conditions are fulfilled, then whatever medical expense we are incurring for this patient, it will be allowed under section 80D. Okay, then tuition fees maximum for 2 children only guys. Under section 80C you will allow it, provided the education is in India. It can be school education or college education, doesn't matter, but education has to be in India, maximum only for 2 children. See section 80 education loan. In education loan, the education can be in India or it can be outside India, doesn't matter, but for tuition fees, education has to be in India only. Okay. Then if the question says assessee has made a contribution to NPS, NPS will go to 80CCD guys. NPS tier 1 account is 80CCD. Basically in NPS we have 2 accounts, tier 1 account, tier 2 account. It is tier 1 account that goes to 80CCD, but tier 2 account has to go to 80C. It cannot go to 80CCD, it has to go to 80C only. But NPS tier 2 account will go to 80C only if the assessee is a central government employee, not state government employee, not any other employee, only if he is a central government employee. So NPS 80CCD, NPS tier 1 account 80CCD, NPS tier 2 account, any case it can't come to 80CCD. So it will go to which section? 80C, but you will get 80C only if the assessee is a central government employee. So what if it is NPS plus tier 2 account plus the assessee is not central government employee? Then what will you do? Can you give 80CCD deduction? No, because 80CCD is only for tier 1, not for tier 2. Can you give section 80C deduction? No. 80C is only for central government employee. Understanding? Then look at the next point guys. In your chapter 6A, where do we say that the payment has to be made in non-cash mode only? Section 80D, section 80GGB and section 80GGC. In these 3 sections, payment has to be made in non-cash mode only. In 2 sections we say if it is more than 2,000, then only non-cash mode. Section 80G and section 80 GGA. Remember 80 GGA? Assessee is not having PGBP, and assessee is making a contribution to outsider for scientific research, or assessee is making a payment to National Fund for Rural Development or National Urban Poverty Eradication Fund, 80 GGA. Okay, then specified mode, only one section we have, 80 JJAA. Okay, then listen, 80 GGB will cover 3 transactions. 80 GGB, 80 GGC, guys, your political party sections. Come on, let's revise that. Under 80 GGB, I am covering electoral trust, contribution to political party, advertisement in newspapers and magazines of political parties. So this will be allowed under 80 GGB. Under 80 GGB, assessee is a company. Now 80 GGC is for other than companies. Other than companies, all other persons will come to 80 GGC. In 80 GGC also, will you allow electoral trust contributions? Yes. In 80 GGC also, will you allow contribution to political parties? Yes. But advertisement in newspapers and magazines and souvenirs of political party, this is allowed only in 80 GGB for company only. This is not allowed in 80 GGC. So listen to me. If an advertisement is being made in newspaper, souvenir or magazine of political party, then for all assessees under PGBP it will be disallowed, guys. Under PGBP it will be disallowed for all assessees. Under chapter 6A it will be allowed. Under section 80 GGB it will be allowed, but only for company assessees. So any advertisement given in the newspaper, magazine or souvenir of political party, under PGBP you will disallow it for all assessees. Under chapter 6A you will allow it, but you will allow it only under 80 GGB for company assessees. Under 80 GGC it will not be allowed. And don't forget, whether 80 GGB, whether 80 GGC, the payment has to be made in non-cash mode only. Irrespective of what is the amount, it has to be paid in non-cash mode only, and there is no maximum limit, guys, in these two sections. Okay. Then let's discuss this point. Let's say there's a minor. This minor has earned 12,000 rupees post office savings interest. Post office savings interest, guys, how much exemption you will give? First of all, 3,500 exemption you will give me. So what is the balance net number now? 8,500. This net number, what will you do? You will club it with the parent's income. But when you're clubbing it with the parent's income, which parent? Parent who has higher income. When you're clubbing with the parent's income, you will give 1,500 exemption, provided the parent is following the normal regime. So how much net are you taxing in the parent's hand? 7,000, guys. 7,000 is going to be taxed in the parent's hand. Now after doing all this, you should not forget chapter 6A. The parent can enjoy deduction either under 80 TTB or under 80 TTA as the case may be. But how much will you enjoy? Will you enjoy 12,000 or 8,500 or 7,000? How much will you get under chapter 6A under 80 TTB or 80 TTA? What is the net number that is forming a part of the parent's income? 7,000, no? So 7,000 only you will allow. Whether 80 TTB, whether 80 TTA, whatever is applicable for you, you will allow 7,000 rupees only. Okay, so this was the whole concept of minors plus clubbing plus post office savings interest plus chapter 6A. Okay, understood? First, I will enjoy the 3,500 post office savings interest exemption. Then this net number I will club. When I'm clubbing, I will give 1,500 exemption. And this net number, this is what I will get as chapter 6A deduction later. Now listen, guys, coming to the next section, section 80 EEB. Under section 80 EEB, assessee has to be an individual. Assessee has borrowed an electric vehicle loan from bank or NBFC to buy an electric vehicle. The loan should be sanctioned in 1920, 2021, 21, 22, 22, 23. On accrual basis, whatever interest has accrued during the year, maximum 1,50,000 deduction you will get. Just wanted to remind you, 80 EEB, who is a lender, bank or NBFC? Why did you borrow the loan? To buy an electric vehicle. When was the loan sanctioned? 1920, 2021, 21, 22, 22, 23. Maximum how much interest deduction you will get? 1,50,000. It's on accrual basis, guys, which means whether you've made the payment or not doesn't matter. How much ever interest you have incurred during the year, you will get as a deduction. Remember, section 80E, interest on education loan, this is payment basis. But the other three, 80EE, 80EA, 80EB, in these three sections, remember that here it is on accrual basis, which means whether you've actually paid the interest or not doesn't matter. If you've incurred the interest, you will get as a deduction. Okay, then comes section 194Q. Listen to me extremely carefully. One explanation, guys, and you should be sorted. Okay, so when it comes to 194Q, what are your conditions? 3 conditions you have over here. Basically in 194Q, there's a buyer. This buyer is buying goods from the seller. So in such cases, TDS will apply under 194Q if three conditions are fulfilled. The buyer, his preceding previous year turnover has to be more than 10 crore. Remember, TCS is from the seller's point of view. 194Q is from the buyer's point of view. So buyer preceding previous year turnover should be more than 10 crore. Then point number 2, section 206C1F motor vehicle should not apply. 206C1 atoms should not apply. Then point number 3, the aggregate purchase between this buyer and seller should be more than 50 lakh rupees. Will you include GST? Will you not include GST? It depends. You remember, if payment is earlier, then you will include GST also. If credit is earlier, then you will not include GST. Okay, so the buyer, his preceding previous year turnover should be more than 10 crore. 206C1F, 206C1 should not apply. The aggregate purchase during the year should be more than 50 lakhs. If all these conditions are fulfilled, 194Q will apply at the rate of 0.1%, guys. 0.1% of what? Of the excess above 50 lakhs. And when will you deduct TDS? At the time of payment or credit, whichever is earlier. 0.1% of the excess. Then when does 206AA apply? 206AA will apply if the deductee is neither giving PAN nor giving Aadhaar. Like for example, in 194Q, for example, buyer is a deductor, guys. So seller, the deductee, if he is neither giving PAN nor giving Aadhaar, so whoever is a deductee, if that person is neither giving PAN, also not giving Aadhaar, then 206AA will apply. Under 206AA, the TDS rate will increase. The TDS rate will be whatever is the applicable rate, or 20%, whichever is higher. But however, if it is 194Q, then instead of 20%, you will take 5% if it is section 194Q. Okay, so rate or 20%, whichever is higher. But if it is 194Q, then rate or 5%, whichever is higher. Alright, then listen to this next point. Let's say I am paying rent. This rent is for plant and machinery. Which section TDS will you think about first? You will think about section 194I, guys. 194I covers rent on land building, plant machinery, furniture fixtures. Land building, the TDS rate is 10%. Furniture fixtures, the TDS rate is 10%. And plant machinery, the TDS rate is 2%, guys. 194I will apply. But 194I, the rent should be, aggregate rent should be more than 2,40,000. But let's say the rent is less than 2,40,000. So it is rent relating to plant and machinery, but it is not exceeding 2,40,000, and because of that reason 194I will not apply, guys. So can you think about 194IB? No, be careful. 194IB talks only about rent on land building. 194IB does not cover rent on furniture and fixtures. It does not cover rent on plant and machinery. Rent on land and building only is covered under 194IB. Okay, 194I covers all the three: land building, furniture fixtures, plant machinery. But 194IB covers only rent on land and building, not plant and machinery, not furniture and fixtures. Okay, now moving on, section 194A, one quick revision of the limit I want to give you. 194A is about interest other than interest on securities. The limit will first depend upon who the deductor is. If the deductor is BCP, now it will depend upon who the deductee is. If deductee is senior citizen or super senior citizen, then the limit will be 50,000. If deductee is any other person, then the limit will be 40,000. But if the deductor is not BCP, it is not a bank, it is not a cooperative bank, it is not a post office, then the limit will be 5,000. Remember, here the limit will depend upon who the deductor is. If deductor is BCP, then it will depend upon who the deductee is. If deductee is senior citizen or super senior citizen, 50,000. If deductee is any other person, 40,000. And if the deductor is not BCP, any other person, then the limit is 5,000. But at the same time, don't forget, if the interest is relating to motor accidents claim tribunal, here the limit will be always 50,000 only. Okay. Now in 194A, BCP can be deductor, can't be deductee. NBFC can be deductor also, can be deductee also, both allowed. Okay, and one more thing, remember, in section I'll just give you one small reminder, two sections, guys, 194C and 194D. CD, remember, in both of these sections the TDS rate will depend upon who the deductee is. The rate will depend upon who the deductee is. Okay, like in 194C, if deductee is individual or HUF, 1%, any other deductee 2%. In 194D, generally the TDS rate is 5%, but if the deductee is a company, then the TDS rate will become 10%. Okay, just giving you a reminder of some TDS points over here. Then when it comes to advance tax, listen to me, one last point, and then I'll take you straight away to the total income adjustments after this. When it comes to advance tax, be careful before you even do any computation of advanced tax. Before you do 234b computation also, first check two things. Out of the two things, if even any one is applicable, then advanced tax concept itself will not apply. Number one, the assessed tax. If the assessed tax happens to be less than 10,000 rupees, you remember what is assessed tax, right? I had spoken to you about this in one of the earlier videos as well. In the return of income video, I had spoken to you about this. Assessed tax is nothing but your tax liability minus TDS TCS credit. That is assessed tax. So if it is less than 10,000, no advanced tax will apply. Also, if assessee is a senior citizen or a super senior citizen and this assessee is having no PGBP, then also advanced tax will not apply. 234B interest also will not apply. Okay, don't forget this. Before you do this calculation, first check if any of these two criteria is fulfilled. Even one criteria is fulfilled, none of these two will apply. Okay, so these were 28 points, guys. Now come on, I'll take you to some total income adjustments one by one. The first total income adjustment I want to talk to you about is relating to partners, guys. See, if the partner happens to be a sleeping partner, okay, then in that case, whatever interest he is getting, for that same 12% interest limit will apply. But whatever salary the sleeping partner is getting, the salary, it will be not allowed for the firm. So if it is not allowed for the firm, then it will also be not taxable for the partner. Understanding? Interest will be the same thing only, whether active partner, whether sleeping partner, doesn't matter. Interest maximum 12% will be allowed. But when it comes to salary for sleeping partner will not be allowed for the firm. It will be fully disallowed for the firm. If nothing is allowed for the firm, nothing will be taxable for the partner, because when it comes to partners, whatever is allowed for the firm only is taxable for the partner. So if nothing is allowed for the firm, nothing will be taxable for the partner. This is for sleeping partner. Okay, be extremely careful. But what if the partner happens to be an active partner? Okay, interest same 12% limit only, but what about salary? The salary will depend upon the book profit in such cases, guys. Now if the book profit happens to be a negative number, then in that case the maximum limit will be rupees 3 lakhs. But if the book profit happens to be a positive number, then in that case you will see how much is the book profit. On the first 6 lakh of the book profit, 90% of the book profit number, or 3 lakh rupees, whichever is higher, on whatever is the balance book profit, 60% of the book profit. This is how you will get the maximum allowable working partner salary. So first you will compute from the firm's point of view, whatever is allowed for the firm, that is what you will tax for the partner. Okay, so book profit, if it's negative, then 3 lakhs will be your maximum allowable working partner salary. If the book profit is a positive number, on the first 6 lakh of the book profit, 90% of the book profit, or 3 lakh, whichever is higher, on the balance book profit, 60% of the book profit, this is what you will allow. Okay, then listen, any interest that you incur before you put the asset to use, whatever interest is incurred before you put the asset to use, don't forget to capitalize. When you do this calculation, slow down a little bit, see how many months, when did the assessee borrow the loan, when did the assessee put the asset to use, that many months interest you will capitalize, which means you will add it to the block, so you will disallow from PGBP. Okay, and only the remaining interest after the asset is put to use, that only will be allowed in PGBP. Be careful. Then tell me about VRS. VRS will be allowed only on payment basis, guys. Assessee actually has to make the payment of the compensation, only then it will be allowed, and it will be allowed across how many years? It will be allowed across 5 years. So 1/5, 1/5, 1/5 you will allow across 5 years. So you will disallow the balance 4/5 and you will allow only 1/5, provided assessee has actually made the payment during the year. Then after this, one more point I wanted to discuss with you, that micro, small, medium enterprises point. If the assessee has to make payment to a person who is either a micro enterprise or a small enterprise, are we covering medium enterprises also? No. If assessee has to make payment to a micro enterprise or to a small enterprise, then in that case assessee has to ensure that the payment is made within section 15 time limit. Section 15 of what? Not section 15 of Income Tax Act, section 15 of MSMED Act. So assessee, if he has to make any payment to a micro entity or to a small entity, then he has to ensure that the payment is made within section 15 time limit. What is the section 15 time limit? It depends if there is a written agreement or if there is no written agreement. If there is a written agreement, then the time limit will be as per the written agreement, or 45 days, whichever is earlier. But if there is no written agreement, then the time limit will be 15 days. So we have to ensure that the payment is made within the section 15 time limit. If it is not made within section 15 time limit, then for now you will disallow, but later whenever you make the payment in that year, it will be allowed again, which means this will be a reversible disallowance. And also, just one small reminder, What is a micro entity? A micro entity is an entity where plant and machinery is not more than 1 crore and turnover is not more than 5 crores. Okay, multiply by 10, that's all. For small entity, plant and machinery should be within 10 crore and the turnover should be within 50 crores. And guys, both these conditions have to be fulfilled. Plant and machinery should be within 1 crore, turnover should be within 5 crores. For small entities, plant and machinery should be within 10 crore and the turnover should be within 50 crores. Okay, this was about your micro, small, medium enterprise point. Then comes my next point, my 33rd point, a really crucial point with respect to employer's contribution to NPS, where you made 1,000 silly mistakes during class. Listen to me. Employer's contribution to NPS. What will you do? You will first check from whose point of view. Is it from the employer's point of view or is it from the employee's point of view, right guys? If it is from the employer's point of view, it will be allowed. It will be allowed under which head? Under the PGBP head. But maximum, how much will you allow? Maximum 14% of the employee's salary you will allow. And here salary means basic salary plus DA forming part. That's all. No commission over here. Okay. Whether 115 BAC, whether normal regime, doesn't matter. For employer's contribution under PGBP head, only one limit you have, which is 14% of salary. Then what about employees' point of view? Here you will apply 80CCD subsection 2. Under 80CCD subsection 2, how much deduction do you get? This depends upon, are we following the normal regime or are we following 115 BAC? Under normal regime, generally maximum we allow 10% of salary only. But then however, if the employer happens to be central government or state government, then we will allow 14% of salary. But if assessee is following 115 BAC, doesn't matter who the employer is, we will straight away allow 14% of salary. But don't forget, employee's point of view, there are two things. This is one of the two things. The second thing is, whatever is the employer contribution to NPS, don't forget to tax it under the salaries head. So employer's contribution to NPS, your first thing will be from whose point of view? Employer's point of view or employee's point of view? Employer's point of view, it will be allowed under PGBP, but maximum 14% of salary only will be allowed. Employee's point of view, two things. Number one, under 80CCD subsection 2, you will get a deduction, both under the normal regime also, under 115 BAC also. And second, employer's contribution under the salaries head, it will be fully taxable. As it is, you will take it and tax it under the salaries head. Then listen to the next point, point number 34. What will you do with income tax refund? Income tax refund, it will not be taxable, guys. Under any head, it is not taxable. So in your in your total income computation, if it is already if it's already credited to the P&L, you will reverse the credit, you will subtract it. But what about the interest on income tax refund? This will be taxable. It will be taxable under the IFOS head. So so both of them you will remove from PGBP. Just that IT refund you will not take anywhere else, but interest on IT refund you will take it to IFOS head and you will tax it fully over there. Okay. Then comes point number 35. Remember section 40A subsection 3 and section 40A subsection 3A, guys. If you have incurred expense in the previous year and you're making payment also in the previous year itself, 40A subsection 3 will apply. If it is up to 10,000, make payment in whatever mode you want. But if you're making payment more than 10,000 rupees per person, per day, per invoice, you have to ensure you make the payment in specified mode only. But don't forget, if you're making payment towards plying, hiring, leasing, goods, carriages, there you have 35,000 limit. When do you apply 48.3A? You apply 48.3A if you incurred the expense in year 1, but you're making the payment in year 2. Then you apply 48.3A. In this case, when you're making the payment in year 2, if it is more than 10,000, you should make the payment in specified mode. Or if you're making payment towards plying, hiring, leasing, goods, carriages, more than 35,000, you should make the payment in specified mode. And one more limit you have, in fact, 50,000 limit. If you're making payment of retirement benefits more than 50,000 rupees, you must make the payment in specified mode. Now, in 40A3, what if you make the payment in I guess there was a small problem with the audio. Now I'm hoping you're able to hear me. So in 40A subsection 3, what if there is a violation? That is, what if you make the payment more than the limit in non-specified mode? Then that amount will be disallowed. It will be fully disallowed, guys. You don't disallow just the excess. You disallow it fully. But in 40A subsection 3A, if there is a violation, here we don't disallow. Instead, we assume it to be income. It is deemed income and we will tax it under the PGBP head. Okay. So the limits are the same. The mode is the same. Only thing is, in 40A subsection 3, I incurred the expense in the previous year. I am making payment also in the previous year. But in 40A 3A, I incurred expense in year 1, but I am making payment in year 2. In 40A 3, if there is a violation, I will disallow the expense. In 40A 3A, if there is a violation, I will tax it as if it is income under PGBP. Okay, then listen to my next point, my point number 36. See, let's say I want to make payment for a depreciable asset. Even this payment, guys, more than 10,000 rupees, you have to make the payment in specified mode only. Now, what will happen if you make the payment more than 10,000 in non-specified mode? Then it will not even enter the block. Like for example, 15,000 I paid in cash, 25,000 I paid in account payee check. Now this 15,000 more than 10,000 which you paid in non-specified mode won't even enter the block. This 25,000 only will enter the block. Okay, and mind you, here you don't have the 35,000 limit, you don't have the 50,000 limit and all. You have only one limit, which is 10,000 limit for depreciable assets. Okay, then comes point number 37. 1 minute. Yes, point 37 was about cash credits. So in case you have any cash credits, unexplained income, unexplained investments and all, two sets of calculations you will remember. If it's a descriptive question, you will do proper breakup. You will show 60% basic tax plus mandatory 25% surcharge plus 4% cess. But however, if it is if it's an MCQ, then you will straight away do 78% effective tax and you will quickly close the question. Okay, then comes point number 38. Stock, guys. Your stock valuation, very common. Total income adjustment. This is when it comes to stock, be careful. Remember the table which I taught you? Yes, opening stock overvalued, you will add the difference. So if overvalued, you're adding the difference. Automatically undervalued, what you will do? You will subtract the difference. Then opening stock overvalued, you're adding the difference. So closing stock overvalued, you will do ulta, you will subtract the difference. Closing stock undervalued, you will add the difference. So if you remember add, everything else will automatically fall in place. Okay, then after this I need to ask you this list of questions. This is my point number 39. Tell me, point number 1, interest under Income Tax Act, allowed or disallowed? You're paying interest under Income Tax Act under PGBP. It will be disallowed. It will be disallowed. It's like a penalty. It will be disallowed. Then fees under 234F that you've paid under PGBP, even this will be disallowed. Basically, income tax. Then interest under income tax, fees under income tax, all this you will disallow. But remember, statutory income tax proceedings, which means some income tax case is going on against you. For this, if you have to incur legal fees or auditor's fees and all, this will be allowed. Okay, then any penalty under Income Tax Act, even this will be disallowed. In fact, any penalty under any law will be disallowed. But what about interest under GST Act? This is considered as compensatory in nature and this will be allowed. Point number 5, what about penalty under GST Act? Any penalty under any act, it's going to be disallowed. Any fine, penalty for violation of any law, even this will be disallowed. But however, if there is any fine or penalty because you breached a contract, this will be allowed, guys. Only a fine with respect to breach of law, only that will be disallowed. Any fine, penalty with respect to breach of contract, that will be allowed. And lastly, income tax, surcharge, cess, provisions, reserves, advance tax, all of this will be fully disallowed. Okay, this was your point number 39. Then after this I have to discuss with you 40A1 and 40A1A. So point number 40 is section 40A1 and section 40A1A. Now in section 40A1, I am incurring an expense other than salary, and on this expense TDS is applicable. I am making the payment to a non-resident or I am making the payment outside India. So I have three conditions. If all these three conditions are fulfilled, two responsibilities. Remember, 3, 2, 1. Come on, guys. So I have three conditions. Condition number 1, I have incurred an expense which is not salary, and this and TDS is applicable on the expense, and the other party is a non-resident or I'm making the payment outside India. Then you will put two responsibilities on me. You will ask me to deduct tax in the previous year and you will ask me to remit the tax within the 139(1) due date. Okay, out of these two, if I do even one violation, then full 100% of the expense you will disallow for me. But however, not a problem. Later, whenever I make the rectification, in that year you will allow it again. It's a reversible disallowance. Totally 3 reversible disallowances you have, guys. 43B, then 40A1 and 40A1A. These are your 3 reversible disallowances. Okay, then similarly 40A1A, here also same 3 conditions. You have incurred an expense. Here it can be salary expense also. Then TDS is applicable on the expense and the other party is a resident and you are making the payment in India. Here it is non-resident or you're making the payment outside India, 40A 1A resident and in India. If all these conditions are fulfilled, two responsibilities I will put on you. You should deduct the tax in the previous year and you should remit the tax within your 139(1) date. In case is any violation over here, then 30% of the expense I will disallow. Even over here, once you rectify in that particular year, I will allow it once again for you. All right, then after this, the next point I wanted to talk to you about is contribution to outsiders for scientific research. Be careful, this will be allowed, but it will be allowed only if the assessee has opted out of 115 BAC. If assessee is following 115 BAC, it will not be allowed. Very important adjustment from the total income point of view. And also remember, once I make a contribution to outsider for scientific research, what the outsider does with my money doesn't matter. Even if he uses my money to buy land, it's okay, it doesn't matter. Understanding, any contribution I make to outsider for scientific research, research in social science, statistical research, allowed under PGBP, provided assessee has opted out of 115 BAC. Once I make the contribution to the outsider, what he does with the money doesn't matter. Okay, then remember point number 42, section 35 scientific research, it will not apply to land, guys. Section 35 AD specified business, it will not apply to land, it will not apply to goodwill, and it will not apply to financial instruments. Okay, then after this, point number 43, in case there is in case assessee is having any income from mutual fund, you will straight away, income from mutual fund or income from UTI, you will straight away take it to the IFOS head, guys. You will remove it from PGBP, take it to IFOS head, and you will tax it under the IFOS head. Income from mutual fund, income from UTI, even honorarium. Remember, we've seen honorarium in multiple questions. Honorarium, all of this will go to IFOS head and it will be taxed under the IFOS head. Dividend income will always go to the IFOS head. Even if assessee is in the business of buying and selling shares, intermediate level, it will always go into the IFOS head only. Then listen to the next point. I'm almost nearing the end, guys. Just 5 more minutes, I promise, and then we'll get done. Point number 44, this is with respect to CSR expense. If assessee is incurring expense on CSR, it will be disallowed under Income Tax Act. But however, if this expense is in the form of contribution to outsiders for scientific research, then it will be allowed. But of course, this will be allowed only if assessee has opted out of 115 BSc, right? So CSR expense as such, it is disallowed. But if the CSR expense is in the form of contribution to outsiders for scientific research, it will be allowed under PGBP, because but then it will be allowed only if assessee has opted out of 115 BSc. Then point number 45, Section 48 subsection 2, assessee has incurred an expense. The expense is relating to business or profession. The other party happens to be a relative. The expense is excess or the expense is unreasonable, it is more than the fair market value. Assessee has incurred an expense which is more than the fair market value, excess expense, unreasonable expense. In such case, the excess or unreasonable expense, that excess portion is going to get disallowed under 48 subsection 2. Understood? Assessee has incurred an expense, the expense is relating to his business or profession, it is excess or it is unreasonable, that is, it is more than fair market value, and the other party is a relative. Now here relative means what? Plus spouse with arrows. This is how I've taught you. That is, if I am the assessee, then my brother, my sister, my parents, grandparents, great grandparents, and so on, my children, grandchildren, great grandchildren, and so on, and my spouse. Okay, notice brother-in-law is not covered in this relative. Very often they ask brother-in-law, guys, but brother-in-law is not covered in this relative, only plus spouse with arrows. Okay, then comes point number 46. I had to discuss with you about one more thing. Oh yes, the depreciation part. Look at this, please. For clinic equipment, depreciation rate is 15%, but life-saving medical equipment 40%. Windmill, energy-saving device, electric vehicle, here also your depreciation rate is going to be 40%. Okay. Then after this, point number 47, section 10AA. 10AA, don't forget how do you do the computation. Net profit into export turnover by total turnover into percentage. You always keep forgetting to put the percentage over here. Don't just do this much into percentage. What is a percentage? First 5 years 100%, next 5 years 50%, next 5 years also 50%. So net profit into export turnover by total turnover into percentage, that will be your 10 AA tax holiday. Of course, only if a SESI has opted out of 115 BSE. Okay, and then comes my last few points. Point number 48, don't forget to split your GTI, guys, into normal rate and special rate income, because chapter 60 can be enjoyed only against normal rate income. Then your tax computation is not complete under the normal regime unless you have thought about AMT also. And lastly, point number 50, your last point, please don't forget to round off. You will round off your total income also, you will round off your tax number also, both you will round off to the nearest multiple of 10. Understood, everybody? That's it. These were your 50 ultimate reminders that I wanted to give you just before you walk into the examination hall. Just 2-3 hours before the examination, I wanted to give you these 50 reminders. I'm hoping you are ready for the exam now. Go kill it, guys. We've put in the best that was possible. Beyond this, nothing was possible. So, with this much preparation, you are going to kill it. When you walk into the examination hall, walk in like as if you have already won the game. Have a calm mind, no tension. When you look at the question paper at 145, focus on what you know and not on what you don't know. You may find one or two adjustments here and there which you don't know. It's okay. Do we want 100 out of 100? No. So therefore, ensure that your entire focus has to be on what you know and not on what you don't know. Okay, ensure when you will feel at various points of time during your your writing part, you might feel that I'm you might feel anxious, you might feel like you're panicking. Every time you realize you're panicking, just ensure that you start focusing on what you know and not on what you don't know. Okay, do the descriptive part first. In an ideal situation, see, when it comes to tax, descriptive part is more scoring than the MCQ part. So do the descriptive part of DT first, then do the MCQs of DT, then do the MCQs of GST, and then come to the descriptive part of GST. Follow this. Please don't do blunders, right? Like writing DT in GST book, GST in DT book, and all those kind of blunders and all, don't do. And one more thing I'll tell you, you may not like it because it is the bitter truth, but I'll still tell you because our faculties used to tell us this, and I think it worked out for me. So I think I do want to tell you this. Don't target finishing 100 marks of the question paper. 100 marks, if you do in an average manner, in a hurry, filled with silly mistakes, it is worse than writing 85 to 90 marks of accurate paper. So basically, if you have two choices, finishing 100 marks but average performance, filled with silly mistakes. Second option, attempting 85 to 90 marks of the question paper but accurate answers. This is obviously always better than this. Okay, so this might be something which you may not like right now, you may not like to hear it, but this is one practical bitter truth that this is how it is. If I'm going to try squeezing in all 100 marks in those 3 hours, I will end up writing way too fast, I will end up making way too many silly mistakes. But instead, if my target is finishing only 85 to 90 marks of the question paper, I can do in a little bit relaxed manner, more accuracy I can ensure, I will get better marks. Okay, so that is it, guys. With this, we are done. Tell me in the comment section that you are ready for the examination and you will ace it. Understanding what is your statement going to be? I am ready for the examination now and I'm going to ace it. Not one silly mistake you will do and come. You will do everything properly with a calm mind, with no tension. Question after question, you will take it, you will kill it, and you will come back. Alright, you will come back a winner. Bye bye, guys. All the best.